Let's go ahead and go through the solution to the first of the Module 8 homework questions. Again, we have a downstream sale of inventory. Assume that Big Company owns 60% of Little. In 2018, Big sells inventory to Little for $100,000. The inventory had cost Big $80,000. Of that merchandise, Little resells 70% in 2018 and the remaining 30% in 2019, and Big uses the partial equity method. Again, Big is the seller, so this is a downstream transaction, which means the non-controlling interest is not affected by this at all. So basically, that 60% ownership figure is irrelevant for the purposes of this question. Okay, so the gross profit on sale, $100,000 in sales minus $80,000 cost of goods sold, $20,000 gross profit. 70% of that is realized in 2018, 30% needs to be deferred. That remaining 30% is realized in 2019. So first in 2018, we're going to go ahead and eliminate the sales and cost of goods sold in the amount of the $100,000 of sales revenue. Again, this entry has no effect on income. We're debiting a revenue and crediting an expense for the same amount. So this does not serve to defer any gross profit. This is where we would stop if all of the gross profit had been realized. Instead, we back up and say, look, of that $20,000 gross profit, 30% is still unrealized, so we have to go ahead and defer $6,000 of gross profit. We do that by adjusting cost of goods sold upward by $6,000. At the same time, the inventory value on Little's balance sheet is inflated by the markup that Big made when they made that sale. So we have to go ahead and decrease inventory to get it down to its correct level. Just to beat this thing to death, the merchandise on Little's balance sheet is being carried at $30,000. Again, this is 30% of the $100,000 of sales revenue. The true cost is 80% of $30,000 or $24,000. So basically what we're doing with that credit to inventory is we're reducing Little's reported inventory from $30,000 down to $24,000. In 2019, the remaining inventory is sold. Again, first we have to do is carry forward the unrealized gain or loss from the previous period. Big Company is using the partial equity method, and again, what that means is that in 2018, Big had a $6,000 unrealized gross profit, which they did not eliminate, or they did not adjust for or counter with their equity method entries. They were using the partial equity method. That means that Big's income in 2018 was $6,000 too high, which means that Big's retained earnings is $6,000 too high. So what we need to do is go ahead and reduce the retained earnings by $6,000. Now again, that is the amount of the unrealized gain being carried forward, or equivalently, that is the inflation in the inventory that's being carried forward from the previous year. And we have to ask ourselves, where is that misvalued inventory? If the inventory is still on hand, then again we're going to have to reduce inventory again with another $6,000 credit. If the inventory has all been sold, then that means that that overvalued inventory has been transferred to cost of goods sold, and cost of goods sold is therefore overstated. So basically all the remaining merchandise was resold in 2019, which means that that inflated inventory value now resides in cost of goods sold, and so we have to reduce cost of goods sold by $6,000 to get it down to its correct level.